the best way to protect losing your home's value or any real estate value due to a natural disaster. Now, in this episode, I'm going to explain something that a lot of Americans don't think about. It's actually rather simple, but it will be profound. So stay with me, because it doesn't matter if my home or any real estate goes down in value because of a recession, like the 2008 mortgage meltdown, which I'll talk about here, or the pandemic, because of something out of our control. But what else is out of our control? Hurricanes, tornadoes, tsunamis, floods, fires. I have never lost one dime of real estate value due to any natural disaster. And I'll show you how you can protect yourself. It's easier than you think, but you need to understand how money works. So get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5+ decades, helping thousands of Americans optimize their assets and minimize taxes, and empowering what I call their authentic wealth. Now, one of the things that I'm very passionate about is helping people understand how money works and how you can actually protect your assets because of all kinds of external forces and influences we have no control over, such as a natural disaster. So when I have had real estate that was affected, but I didn't lose because of a mortgage meltdown or a recession, or because of earthquake damage or a tornado, or if it burned down, I can sleep because I will not lose a single dime. And people say, well, that's because you have homeowners insurance? No. In fact, a lot of people who have had homeowners insurance, they were nervous waiting for the homeowners policy to actually pay up and pay what they thought they would receive for the value of their home. I don't ever have to worry about that. Yeah, I have homeowners insurance, but that's just icing on the cake. Why? Well, okay, let me go into a little explanation, first of all, on how money works so that you'll understand this. So please listen close. There's 4 things you can do with money, okay? You can spend it, lend it, own with it, or you can give it away. Now, when people say, what do you do with your money, Doug? I own with it, but I also loan. I double dip. How? Okay. I own and loan on the same asset. So here's basically what makes the world go round. It's called arbitrage. What's arbitrage? It is where a bank, these mega wealthy banks, would wither up and die if they stopped paying interest. A bank or credit union's greatest asset is its liabilities. They don't view interest as their foe. It's their friend, okay? A bank will gladly pay interest of 3, 4, 5.5%. So let's say they pay you 4.5% on a certificate of deposit. Are they just a benevolent institution? Do they put your money in a vault? No. They turn around and invest it. Where? Did you know that they put 30 to 40% of their tier 1 assets? What's a tier 1 asset? That's money that has to be liquid and safe in case somebody runs on their bank and asks for all their money out of their savings account. They put it in insurance companies. That's where I put my money, okay? So I bypass the middleman and put my money directly into the insurance company and earn more than 4.5 because they can go out and earn in the insurance company a rate of return greater than what they're paying you, okay? In 2008, banks were paying less than 1%. Every $1 million, they were paying $10,000 a year, and they were turning around, putting it in an insurance company and earning 5. How much more is 5 than 1? Don't say 4. I'll show you why here in just a second. They might loan the money back to you at 7.5% on a home equity line of credit. And so they're paying you 4.5 and they're charging you 7.5. That's called a 3% spread. They have overhead, they have costs. And after all of that, they may only make 1%. And they make millions, billions. Hello? So I can show you how to become your own banker. Now, let me review this again. Back in 2008, when 400 banks went under, 900 more were on the brink of going under. That's when the federal government asked the 5 major banks in America to disclose where they have their tier 1 assets for liquidity and safety. And it was in BOLI, bank-owned life insurance, and that's where I put my money. Back then, banks, every $1 million of OPM. What's OPM? Other people's money. They were borrowing OPM and paying less than 1%. Let's just say 1%. They were paying $10,000 annual interest. They were paying $10,000 and thrilled to death to pay that. Why? Because they turn around and put it in insurance companies and earn 5. I asked you a second ago, how much more is 5 than 1? Don't say 4. It's 500% more. It's a 400% increase or profit, but it is 5 times. Let me put it this way. Would you hire an employee for 10 grand that made you an extra 50 grand? Would you buy a widget machine for 10 grand that made you an extra 50 grand? That's got a 500% return on employment cost or equipment cost, a 400% profit. You got it? Okay. Now, here's me. For the last 40 years, on my real estate, such as my house, I have borrowed at low rates. I have borrowed at higher rates. I've borrowed as high as 21% back in the 1980s, okay? But I probably borrowed at an average of 6%, but I always do it the right way to make sure it's tax deductible. Now, some people watch this and they say, well, people don't itemize deductions anymore. Well, that's dumb, in my opinion. You can itemize deductions simpler than you think. You can borrow your home equity for business purposes and deduct it out of your business, okay? You do it the right way, you can deduct it. So let's not even go there. I can show you how to deduct it because in my tax bracket, 33%, if I borrow at 6%, I get to write off that $60,000 off of my business tax return or my personal. And so in a 33% bracket, I'm saving a third of that in tax, which is 20 grand. I get 20 grand back. So the net cost of a 6% mortgage, this tax deductible is 4. Everybody understand that? I'm only really paying $40,000 net. Okay. Now, my favorite financial vehicle is where banks put their money, insurance companies. And because I link to an index, I earn usually 11 to 14%. But even if I do not rebalance and diversify like I teach on this channel, it's a no-brainer. I can earn 9 or 10, but let's say I only earn 8. This is so easy. How much more is 8 than 4? 100%. Okay. Now, would you hire an employee for 40 grand if that employee made you an extra 80 grand? I'll do that all day long. Now, in actuality, I borrow at a net cost of 3 and I earn 9 or 10. I earn 300%. Okay. I'm just showing you how easy this is. So let's go back to how I protect from losing my real estate value. If I keep my real estate mortgage to the hilt, which I do, okay, and it gets destroyed in any kind of a natural disaster, a flood or a fire or anything, I can sleep because my money is not trapped in the property because my money would go up in smoke, so to speak, if I left it there. Because if it goes down or it gets destroyed, I have to fiddle around with insurance claims and argue with my homeowner's insurance company that they need to reimburse me. And that now to rebuild this house is going to cost this. And they say, well, you weren't insured for that much. And, I'm sitting there going through all kinds of justification to try to get enough money. And I'm probably not going to have enough to rebuild it at today's cost and everything else. I don't worry about all of that because I insure it for adequate, but I don't have to wait around. I have the money. Same thing with rental properties. I will keep earning 100 to 300% returns on rental properties, even if they're destroyed or vacant. They're not being rented. Most people who own real estate, if they're vacant or they get burned up, they're in trouble. Why? Because they didn't understand this, okay? Now, the key elements of a prudent investment, okay, real estate does not pass, they fail. Liquidity. You need to have liquidity, the ability to access your money when you need it. If you have it trapped in your real estate, there's only one way to get it out, and that's to borrow it out. And when you need it, the worse it's the hardest to get. Try borrowing your real estate equity when the house is destroyed, okay? It would be far better to have that equity somewhere else before you need it than need it and not be able to get it, okay? And so you need to have liquidity. Otherwise, you got to sell it. But you can't sell it if it's destroyed. Safe. Safe from what? From market downturns, pandemics, recessions, natural disasters. I don't lose money in my real estate because it's not there. I've had sharp asset protection attorneys come and say, Doug, you solved a problem I've been trying to solve for my clients for years. Who is going to even sue you for your real estate equity if it's not there? If it's over in a max funded insurance contract, it's next to impossible to penetrate in courts of law. They said, you solve a problem very simply. Well, then you want to earn a rate of return. I want a rate of return not just equal to the net cost. I want to have a return 100, 200, or 300%, or even 500% more. Sound too good to be true? No, it's not. So you need to understand there's three kinds of people. There's strivers. They just pay interest, okay? Arrivers who earn interest. And so some people will quit. Well, yeah, there's two kinds of people in the world, those who pay interest and those that earn interest. I go, that's cute. But no, there's a third kind of person. The thrivers. Thrivers in the world understand when it's wise to pay interest to earn more interest. This is what bank, credit unions, insurance companies do. Hello, and they are multi-trillion-dollar institutions. Now, there's three marvels of wealth accumulation: compound interest, okay, tax-free accumulation versus taxed as earned or tax deferred. But the third marvel is safe positive leverage. What's leverage? It's the ability to own and control assets with very little or none of your money tied up at risk in that asset. That's what I like. But leverage without liquidity is stupidity. Most people who have been over leveraged, let me give you an example. If you had $500,000 cash, you could pay cash for one $500,000 rental property, rental home. Or you could leverage and take $100,000 of that $500,000 and pay a 20% down payment for each of 5 homes. Now you have $2.5 million of real estate appreciating, but now you have no liquidity because you've tied all that up in the property, just as bad as if you paid cash for a $500,000 house. If in any one of those situations, if they get destroyed in a natural disaster, you will lose, guaranteed. But if you've separated 100% of it, which I do, I take out 80% loan to value on a first mortgage, and then I take out the last 20% because I have good enough credit to do that. I mortgage 100%, okay? But I keep it out liquid. I've never paid a down payment for any piece of property that I've acquired. I've satisfied down payments, but not with my money, okay? So having done that, why do I do that? Well, the math is simple. I've helped thousands of Americans stack up an extra $1 million simply by keeping 100,000, just 100,000 separated from a piece of real estate. If they borrowed that at 6.5% interest and they earned 8.5%, people will say, you'll do all that for 2%? Banks do it all the time. But actually, if I can tax deduct that 6.5%, it doesn't cost me 6.5%. It's more like 4.5%. And if I earn 8.5% compound interest tax-free, compound interest versus simple interest tax deductible, I do that over a 30-year period with never repeating the process. I just let it sit. I made an extra $1 million. Math does not lie. If I did this on 400,000 of equity, we're talking 4 million. If I did it with 100,000 of equity, but every 5 years I refinanced the property and it went up in value just 5% a year, I'll end up with 4.6 million extra dollars. Math doesn't lie. Okay. Now, if you don't believe this, you might as well stop watching this video because you'll never get it. Okay. But folks, let me show you. Back in 2008, again, banks, every $1 million of OPM, they borrowed at 1%. They were paying $10,000. And if they only earned 4%, that's 40 grand. How much more is 40 than 10? It's 400% more, okay? I was borrowing money back then at 3.75% tax deductible interest. Interest rates were low. I had good credit. A net cost of 2.5% in a 33% bracket. every $1 million, I only had to pay $25,000 a year in interest. I was making $100,000, 10%. How much more is 10 than 2.5? 400%. Banks were making 400%. I was making 400%. We were both happy. That was happening regardless of whether I had renters or not, okay? Now, you can become your own banker. My own home in 2008 dropped in value. Now, December of 2007, I can see the writing on the wall, and I refinanced my house, 80% loan to value on a first mortgage. It was valued at $1.5 million. I borrowed 80% loan to value at 4.5% tax deductible interest, 33% tax bracket. That's a net cost of 3. So I was paying $45,000 in interest on my mortgage in 2008. On that 80% of that, okay, which is $1.2 million, I was making 8%, okay, and so I can be making $120,000, especially on the full $105 million, because I was, but I could be making 100. How much more is 120 than 45? 75,000. I would be giving up $75,000 if I had my house paid off. Hello. Now, my house went down in value in 2008 to $1.1 million. If I would have had my money in the property, I would have for sure guaranteed lost $400,000. But let me ask you this. If that house would have been destroyed in Hurricane Katrina or Helene or a fire, who's in control? Me or the homeowner's insurance company? I am. Because I didn't lose one dime of that $400,000. I had critics going, neener, Mr. Andrew, you're underwater. You owe $400,000 more than your house is worth. Did I care? No. The mortgage company was thrilled. They didn't have to foreclose on me like they did everybody else that had all their equity trapped in the property and lost their job in 2008. Why? Because that $400,000, if I was paying 6% tax deductible interest and that cost of 4, I only had to pay $16,000 a year in interest on the second mortgage. I was earning at least 8%, actually more like 10, but 8% is 32. How much more is 32 than 16? 100% more. In order to service the mortgage, I only had to peel off half of the interest. I had the other half to buy gas and groceries, whatever, if I got disabled or whatever. Who was in control? I was. I could make the mortgage payment, no problem. I did not lose a dime. It took several years before my house came back to worth $1.5 million. In the meantime, I was making double to triple the cost of the funds, whether the house existed or not. Are you getting it? Okay. So I have many clients that do what I do. And I had a client back then. Every rental property, he refinanced at $1 million because all of his lending institutions said, "Oh, we'll refinance your properties for $1 million, each one of them, no question, at 4.5% interest." So he did. He was going to pay $45,000 a year in interest on every $1 million mortgage on every rental property. In his 33% tax bracket, that was a net cost of 3. He pays out $30,000 on his IUL laser funds. He was earning 9 net. How much more is 9 than 3? And 9% was tax-free. 300%. He says, "Doug, you are making me so much money with this wisdom. I'm making 300% rates of return, whether I have renters or not. Whether the rental property gets destroyed in a fire or a flood, I still make 300% because my money is not trapped in there. I would lose if it got destroyed in a natural disaster in a paid off property." He said, "I can't believe I didn't understand that. And I thought I was smart." Now he's really smart. Are you getting it? Okay. So that's what I would recommend you do. Keep your real estate equity separated. And then if you ever suffer losses due to market downturns or natural disasters, you don't have to worry because you're making money whether you have renters or whether you're there or not, and you can wait and talk to the homeowner's insurance company to rebuild your house. But in the meantime, you're making 3 times more than the mortgage. In fact, the mortgage company would probably give you a break because it burned down because they require fire insurance, and so they're taken care of. So now it's all gravy. Hello. Folks, now one thing I haven't said, where do I put this money to earn 9 or 10%? A property structured max funded IUL laser fund. And we do the same thing. Every $1 million that I access out of my laser fund, I can borrow that at 2% and they'll credit me 2%. It's called a zero cost loan and it's tax free. But most of my clients do what I do. We borrow at 5 and we keep earning 10. How much more is 10 than 5? 100% more. We do the same thing. We are our own banker, even with the money we have separated from real estate over in an IUL laser fund. You want to see how to do this? I'd recommend you study this book and get in touch with us if you've had a few ahas here. So you can go to Amazon and buy Laser Fund for between $20 and $60. If you do, thank you, but I'll gift you a copy for free. Simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, and I'll pay for the book. I will fire out a hard copy to you via priority mail. And when you go in there to claim your free copy, if you'd like to listen and learn or watch and learn, there's formats there for your investment. You can schedule to attend one of our free educational webinars that we do on a weekly basis. You can even schedule to talk to an IUL specialist with no cost or obligation to see how a property structured max funded IUL can be the dream solution for your real estate so that you will never lose any of that equity due to a natural disaster and have to worry about how you're going to live and have the money to live if that happens to you, God forbid, okay? And so go in there. This is actually 2 books in one because this side are all the charts and graphs and explanations, 200 pages. This side are all the stories. 100 pages, 12 chapters with 62 actual client stories of how to diversify and create the foundation for tax-free accumulation and tax-free access to your money. And so I implore you to do this and understand the best way to protect yourself from natural disasters, but you'll also learn how to protect yourself from the negative impact of taxes, inflation, and market volatility by using the same vehicle.